Have you ever wondered how some of the wealthiest people out there get these massive life insurance policies without touching their investments? Well, that's exactly what we're digging into today as we tackle one really important question.
Think about it. It's a strategy that lets you fund a multi-million-dollar policy, all while your own money stays invested and keeps growing. But, with that kind of financial power, there's always a catch. So the huge question we're answering is this stuff actually safe?
So here's our game plan. We'll start with the basics, then look at what makes it safe, and of course, where the hidden dangers are. We'll also figure out who this is even for, and then we'll land on a final verdict. Let's jump in.
All right, first things first, let's get a really clear picture of what this high-stakes financial tool is all about.
At its heart, premium financing is really all about one thing: leverage. It's about using borrowed money. So instead of you having to sell off stocks or real estate to pay for a massive life insurance policy, a bank steps in and pays the premiums for you. You pay the bank back over time. And the best part? Your own capital stays right where it is, hopefully working hard for you.
This here breaks down the mechanics perfectly. It's kind of like a three-step dance. It all starts because someone needs a big policy, right? Usually for something like estate planning, so the family doesn't have to sell the farm, literally. Then the bank comes in and provides the loan for the premiums. And of course, the bank needs security, so the loan is backed by collateral, which is usually the cash value inside the policy itself, and maybe some other assets too.
Okay, so I know what you're thinking. The whole thing is built on a giant loan. How on earth can that be safe? Well, let's take a look at the blueprint for how this is supposed to work when it's all set up the right way.
These right here, these are the 5 key pillars that hold the entire structure up. It's not just one magic bullet. You need solid collateral backing the loan, a loan structure that's conservative enough to handle bumps in the road, a top-notch insurance policy from a great company, a clear exit plan from day one, and you've got to have advisors watching it every single year. When you get all 5 of those lined up, yeah, it can be rock solid.
But, and this is a really big but, for every one of those safety pillars, there's a potential crack in the foundation. Anytime you're playing with leverage, there are risks. So let's be honest and look at where this can all go sideways.
And here are the big pitfalls. It's kind of funny, right? They're basically the mirror image of the safety factors. If the policy's performance doesn't live up to the hype, or if interest rates suddenly spike, or if your own financial situation changes, problems can pop up fast. But you want to know the most common mistake? Not having a formal way out of the deal planned from the very beginning.
So this all leads to a super important question. Who in the world is this really for? Because let me be crystal clear, it is absolutely not for everyone. Let's paint a picture of the ideal person for a strategy like this.
First off, let's just talk numbers. Banks have these thresholds for a good reason. And while it can change, a really common starting point for your net worth is $5 million. This isn't a tool for the mass market. It's designed from the ground up for high net worth folks. And that net worth number, well, it's just the tip of the iceberg. This checklist shows you exactly why it matters. A lender's going to go through your finances with a fine-tooth comb. We're talking your total wealth, sure, but also your liquid cash, your credit score, and why you even need a policy this big in the first place. Their main job is to minimize risk, and they won't sign off on a loan like this unless they're totally convinced it's safe for everybody involved, especially you.
All right, we've looked at the mechanics, the guardrails that keep it safe, and all the potential risks. So, after looking at both sides of the coin, let's boil all this down to one clear takeaway.
So what's the verdict? The answer is very direct, but it's also very conditional. The key word is can. It can be safe. And that's a world away from saying it is safe, period. The safety here isn't automatic. It's something that has to be created through very specific actions and conditions.
And that really brings it all home. Safety isn't something that just happens here. It has to be engineered, piece by piece. It all comes down to having the right client, the right conservative design, and the right team watching over it every single year, right from day one. If you're missing even one of those pieces, the whole thing can flip from a smart strategy to a dangerous gamble, and it can happen fast.
And I want to leave you with this final thought. This whole strategy, when you get right down to it, is a trade-off. You're using leverage to preserve your liquidity. So the ultimate question isn't just about safety. It's about which of those 2 powerful forces, leverage or liquidity, is the right one to help you build the legacy you really want to leave behind.